Hello, everybody. I'm here with my good buddy Imran. Imran, how you doing?
Hey Brent, how are you, man?
Good. So we kind of want to cut right to the chase today, and we want to do a new take on a video. We have a very interesting market today. We had a rally over the last couple of days. In fact, we're up 3% this week. Today is Thursday, May 27th. So we had about a 3% rally in the S&P 500, and this PCE number is coming out today. And one of the things I am not assigning edge to, but I'm worried about is sort of a right tail move where we really break out and push higher in the market. And so I said, hey, let's talk with Imran today. Let's throw a couple of interesting call spread structures up, and we'll just give them a quick analysis and hopefully present a few ideas for some trades here that protect you on that move if we do get a rally up into the 4,300 area by June expiration. Now, June expiration is very large. It's a big VIX expiration on the 15th. We got the FOMC on the 15th, and then we have a big June equity OPEX on the 17th. And we're both flagging the 4,300 level as kind of a max upside line. I'm flagging that because there's a big JP Morgan put leg at the 42.85 level. And we also see Gamma really flipping kind of in that same area, likely due to that JP Morgan strike in big part. And Imran, do you have any insights quickly on that upside target area that you want to add?
Well, like I say, it's been that area 42.50 and above has kind of been the trigger, right, where we think the street flips a little bit more long vol.
Mm-hmm.
It also looks like sensible retracement level. If you look at how much we've fallen recently, where we could realistically bounce back towards before people start reselling again, because there's been a
Yeah.
lot of people who've been short and kind of covered it, given that things felt pretty oversold, right?
Yeah, yeah, and it's interesting because that is a big kind of a synergistic area, so to speak, with where we just see like the gamma trade, negative gamma sort of exhaust. And I think vol would be pretty beaten up at that point. So the first structure we're looking at here is one that you suggested, and it's a ratio spread. So we're using Thinkorswim here, just a basic platform that anyone has access to, right? Just because we want to make it sort of a simple analysis here for everybody to get an idea around the types of things you want to consider putting on here. So the trade that we first suggest here from Imran, and again, these are just ideas, not investment advice, is to buy the June 4050 call and then sell two. So this is the ratio, sell two of the June 4200 calls. Now, one thing here, we're looking at SPX. Obviously, there's a much larger notional value. You could do the same trade in spiders or probably even Qs and get a similar payoff structure if you want to risk a little bit less than what you see on the screen. But Imran, kind of walk us through the idea of this ratio spread.
Yeah, so I wouldn't call this a protection trade for a sharp squeeze if that's what you think is going to happen, because actually you're going to lose money on this trade.
Hmm.
It's more about you think we're in that kind of bear market rally. We're going to potentially have a grindy move over the next 2 weeks up
Hmm.
towards those resistance areas that we foresee at 4,300 area, between 42 and 4,300 area. That's kind of your sweet spot where you go up there. This trade will make you some money, basically, right? And the reason for doing ratios and stuff is typically because you think vol's still quite elevated in the big picture. And if we rally, that's when vol tends to come down, right? So you're protecting yourself from the scenario that you get your directional view right on the market. The market
Yep.
does go up, but because the vols come down, you wouldn't make any money if you were just buying outright calls potentially, right? So that's you're trying to
Exactly.
kind of counter that, preempt that vol move that you expect to see, and use this ratio structure to do it.
And that's actually the key point here is why we're looking at spreads instead of outrights. And we're talking about just how vol is shifting kind of right after we present these two spreads. But the idea of selling these two is you want to protect yourself from that decline in implied volatility. And what's interesting about this structure is like you probably want to hold this arguably to expiration, because if we pin that 4,200 line, that's your max payoff area. And it is a little bit slower to generate that P&L as the market grinds up. But hopefully as the market grinds up, the volatility is coming down. And again, it's decaying those 4,200s that you're short. But that 4,100 is increasing. Excuse me, the 4050 call it your long is increasing in value and providing you some positive P&L.
Yeah, exactly right. A lot of that P&L is coming late in the day, and it's coming to you through decay of those 4200s, right? So you don't
Right.
expect to suddenly get paid that lovely max payout point on your turquoise line. You're not going to
Exactly.
get it until much later in the trade, and actually you don't really get it until the last day.
Right.
So often with these trades, the risk reward looks very attractive, right? We're spending around 25 points for a
Right.
max P&L of 125 points. So 5-1 payout looks super attractive. You think, oh, it's a great trade. And the break even point, which is where you've got that red line going through zero, that break even point is, fairly comfortable. But just bear in mind that 5-to-1 payout's only coming to you on the last day of expiration, and
Right.
that happens to be 2 days after the FOMC meeting, I believe, which
Right.
is on. Right. So for the market to just sit there at exactly where you want it to for those 2 days, it's quite
Could be
unlikely,
a
right?
little
So
gnarly. Could be a little gnarly on FOMC day. But and
yeah,
to your sort of point, I mean, the one thing that a lot of these risk systems don't do well is they don't adjust sort of the volatility surface. I think very accurately. And so here's the purple line is what they estimate the payoff will be on 6/3, and you can see that. Obviously, as you mentioned, if we jump today because of PCE in the market, oh, look, inflation's coming down, we have another 1 to 2% rally. The structure is not going to look that great in terms of the payoff. But after sort of the holiday weekend, and if we kind of just grind along in there, that P&L on this structure is going to come back pretty quick. So you got to sort of be ready, as you mentioned, that this thing, especially if we jump quick here over the next couple of days, like initially this is not going to look that great, but then you have that sort of time decay arguably playing in your favor. And if we're wrong and the market just decides to launch, this structure obviously, because you're short those two, could start to hurt you. So you need to actively sort of monitor that and plan to adjust around that.
hey, just before we go on to your one, another way to kind of manage this, to kind of have, because we've got an event, like you say,
Mm-hmm.
of the move the market and knee jerk spike, you could do this ratio maybe as a 1/1 or a 1/1.5 initially. And then when you get that knee jerk pop from the news, then you sell your balance out basically, right? So
Very
that
good
would be
idea.
thinking
Yeah.
about it.
And you can see here, I switched it quickly to a 1-to-1, which is just obviously a call spread, and the payout changes fairly dramatically. But again, if volatility does drop fairly sharply, we're going to touch on that quickly after this next spread. It's going to hurt you a little bit more. So you bring up a great point. You can leg into this position as well. So let's quickly flip to this other calendar spread. So in this case, it's a long June 4100. So you get a fair amount of deltas. That's not too far out of the money at the moment. Pre-market, I think futures around 40.75. And then I was looking at selling a 4200 July call against it again to protect on the volatility a little bit. And you suggested a trade which actually looks a little bit more interesting. Instead of that short 4200 leg, we're going to short 2 of the 4500 July call. So this is something of a modified calendar spread. And the idea here is that if we get a really explosive move to the upside, you're going to provides you a little more profit. You still get that volatility offset. And modeling this is a little bit tricky, obviously, because it's a counter spread.
Yeah, and the reason I suggested selling the 45s twice instead of selling one of the 42s in July against your long June is just because, typically a good rule of thumb when you're trading options is to say, I want to be short the strikes that I don't think we're going to be able to blast through,
Right.
right? I want to be short the strikes that if we get there, we're kind of running out of steam there, basically,
Right.
right? It's a strike that maybe we can get to, but we're not going to go through. Whereas by selling the July 42s, there's pretty good likelihood we're going to get through that, and we could get through that in the next week or two, right? So you don't want to find yourself in that situation where that July short is, too close to the money or even in the money. You'd much rather be short an option that's out the money and stays out of the money. Whereas the option that you're long, if we go to 42 and above, that's more than 100 points in the money, and you're sitting pretty on it, basically.
Right. One of the interesting things, obviously, with this structure is that if we get a gappy move over the next week, this is going to give you much more immediate payoff in theory, right? The P&L is going to look a lot better earlier in the trade, arguably than as we sort of get to expiration. As we get to expiration, I think the two structures shift, right? The first spread probably starts to look better as we get towards expiration, and arguably this one could look a little bit worse. Than the interesting thing too to note here is on the downside is this structure. If the market just sort of tanks and we go way below 4,000, this structure on the chart here looks like it loses you probably about double the money, right? Because on this first trade, you're set this fixed cost of $2,600 to the downside, obviously, and then this would look like it loses quite a bit more, but the chart doesn't necessarily do it justice because those 4,500s are going to get beat up, and the way that vol shifts, you could arguably have a little bit less of a loss, right, initially if the market moves down.
Yeah, I mean, ultimately, the easier way to calibrate this is to kind of say, what is my headline delta?
Right, to your point on delta, because this is a 1/2, the delta is a -3, it shows at the moment, so it's basically a zero delta spread.
Yeah, so if the market drops, then it won't lose any money because it's got no delta on it. Just like if the market rallies, it won't make any money today because it's got no delta on it, right? It's going to make its money through time if we're higher, basically, right? That's the way it's going to kind of evolve. Whereas your structure is actually a positive delta structure because Your June 41s are quite heavy on their delta. You're selling two of those far out of the monies. You're probably still positive delta, roughly 10%, which means if the market drops, you will see some losses. But because your Junes contain more gamma, you'll get stopped out of those losses on the way down, basically, right? That's the thing. So I think both structures have got their merits. One of them's probably something you monetize quickly if you get a spike, which is your one. The other one is a slower burner. If you're playing that scenario where we're going to gravitate a bit higher into that expiry and you're going to let it go, and you're actually comfortable being taken short the market above 4,300,
Yeah.
then my structure's fine because it's going to effectively deliver you a short if we rally up there. And you're like, okay, that's the level I'm happy to be short. And if we end up pinning at 42, then you make a load of money, basically.
Yeah, good point. So, if you're, again, I think the summary there is perfect. If you're comfortable with this pinning idea into the 42 to 4,300 area, the first structure arguably is a little bit better. And if you're comfortable sort of with that jump risk, I guess, initial jump risk, whereas the second structure, if you really are super bold, maybe the second structure makes a little more sense. And so I just want to quickly touch on this idea of implied volatility. If we look at the VIX futures here, this is obviously zoomed out a little bit, but the idea that if we do rally, the VIX and the VIX term structure could really deflate, quite a bit, particularly off this PCE reading. And that's why we're a little bit worried about just getting long kind of out of the money calls or, anything kind of more than an at the money, because you're just exposed to that decline in implied volatility. And so, you think you're going to get paid as the market rallies if you own calls, but that implied volatility offset kind of drains some of that value, arguably, that you're going to get on a rally. And so, again, that's one of the key reasons why we were looking at spread trades here to offset some of that decline in implied volatility.
Yeah, so the VIX, I agree, the VIX definitely got a little bit of downside potential. Lately it's really struggled to make new highs as the market was trading pretty weak. So that's what's going to make you nervous about owning too much volatility here, right? Because if the VIX couldn't really go to new highs when the market was weak and breaking down, if the market's got a 2-week rally in it, the VIX has got some downside, right?
Yeah.
So definitely don't want to get caught too long vol on the rally, basically.
So you have a new volatility dashboard to this point on VIX futures. And so why don't you walk us through that and what you're looking at here?
Sure. So this is my new Options-Insight vol dashboard I'm going to release sort of in a month or so. It's kind of in testing phase at the moment. But basically, it's just trying to encompass and summarize everything going on in volatility on whatever asset you're looking at in a one-pager where you can kind of see what's going on. So here, I've got obviously the spot price of the S&P and where that is, and kind of get a gauge of where that is in the Bollinger Bands, whether it's kind of at the lower end of the range or the higher end of the range, to give you a sense whether you want to be putting on bullish trades or bearish trades. Mm-hmm. So here you would look at that and say, yeah, I'm thinking bullish trades probably make sense right now, given where we are. Then you look at the implied vol, and that's a similar chart to the VIX, but it looks at a few different maturities at the rolling implied vols for the at the monies, and again, kind of shows we're kind of towards the top end of that range, or we have been for the last year or so. So clearly there is still some downside potential for the vol. I've got the skew here as well, looking at 30-day and 90-day skew on a normalized basis, so like 25 delta skew, stuff like that. And that's at the low end of the range as well, right? Skew's been battered quite hard recently.
Yeah.
And that leads into our trade suggestions, which are call spreads, which are a skew purchase, right? When you're buying an option and you're selling an option with a higher strike, you're typically, that means you're buying skew. And you'd probably be buying skew in an environment where skew is low rather than expensive.
Very
so
good
you can
point.
see these green lines here that show the 1 month, and that's the maturity that we're looking at. That's quite low in terms of its range. So to own skew when it's low, not a horrendous idea. And then lastly, you've got the term structure here on this chart, just showing you quite a flat term structure.
Right.
Got a little bit inverted last week, starting to come back down in terms of the bright green, which is today. Right. So that's still got some room to go into contango, which we know is where it typically likes to live. So you could see that front end go back towards 20 and go into a more contango shape, which is again why we want to be a bit careful about being long too much Vega in the front end, basically, right? So those are my charts around the sides. And then in the middle, I've just got kind of what I call my strategy compass, which just kind of helps give you a sense of what the right trade might be. And again, it's not investment advice. It's not a certainty to be a winner, but just given where vol is, given where spot is, what sort of trades is this thing pointing towards, right? And it can show you with these kind of crosses on here that typically selling puts isn't the worst idea, given where vol is and given where spot is, basically, right? So right now. And then the last thing is it's got quite a lot on it. The last thing is what I call my carry indicator, and that basically is looking at realized vol versus implied vol and trying to give you a sense for whether you want to be short gamma or long gamma, basically. Are options carrying themselves, or are they just bleeding badly, basically, right? So when this thing is on towards the max pay, it's like saying you want to be long options, you want to be long gamma because things are moving around and you're able to monetize those moves. If you're on the max earn, then you're like, options are quite expensive. I'd probably rather be short options and earning, right? So combination of all of these things hopefully makes you a more informed trader when you're trading options, basically.
And the carry indicator is going to be interesting to watch over the next kind of few weeks here, particularly rally and some of that negative gamma comes off and implied vol comes down. Then we could have a fairly big gap between implied and realized, right? Because I think realized still up around 25 to 30, somewhere in there.
Yeah, I mean, what you often tend to see when markets are moving around, they have their shock, they have their little bout of vol, and then something comes to the market to give you a bit more confidence and create a bounce. And then when that bounce happens, implied gets crushed, but realized still contains like past data that was when the market was moving. So implied leads on the way back down, and so the carry indicator will look and say, that's why you need to understand the internals of these indicators. The carry indicator will say, oh, options are realizing, you don't want to be short options. But that's only because they contain a load of moves that happened a month ago, which are about to drop out of the sample set. Once they drop out of the sample set, suddenly realize jumped back down, and your carry indicator looks amazing, right? You should be short options. So you need to watch these. You need to understand how they evolve to really know how to trade them, basically.
It's an excellent point, and we're only about 2.5 weeks now to that June 15th FOMC and a big VIX expiration. There's a lot of big VIX index options tied to that expiration. So this whole dynamic, I think, of the VIX pinning at 30 and not breaking out, I think there's going to be a lot of shifts in the volatility, implied and realized environment over the next 2 to 3 weeks. Obviously, there's a lot of catalysts. So all right, Imran, we're going to leave it there. Thank you very much. If people are interested in getting a hold of you and checking out that dashboard, how do they do so?
Sure, yeah. So options_insight is my handle on Twitter. My website is options-insight.com. You can chat to us, book a 15-minute chat, see what we're all about. I put out a ton of content on Twitter, so you get to see what I'm up to on there. But yeah, that dashboard is something I am rolling out over the next month or two. It's going to be part of one of my subscriptions, and hopefully it's going to help a lot of people understand options and vol a bit better, basically.
Nice. And of course, you can go to academy.spotgamma.com. That's our training course. If any of this stuff you want to dig into it a little bit more, any of these dynamics we talked about today. And Imran is the beautiful face of the SpotGamma Academy. And I'm at SpotGamma, and you can check us out at spotgamma.com. Imran, enjoy your day. We got the PCE number coming out, and apparently that controls our fate.
Yeah. All right. Take care, mate. See ya. Bye-bye.